Vanguard's market forecast for the next 10 years. And this is what I use in my Right Capital. And so we're going to discuss this. It's pretty important. I mean, pretty important stuff. Let's just dive into it, man. Market perspectives, dateline November 29th, 2022. And actually, let's see something here. The Vanguard Capital's market, Vanguard Capital Markets Model. Vanguard Capital Markets Model. I always have a hard time with that. VCMM. And here we go. The key highlight: next year, Vanguard expects a recession and a growth of 0.25 to 1/2, 1%. All right, look, the market's already forecast that, so big deal. So, like, oh my goodness, the next recession is coming. Let me sell now. It's already happened. I mean, it could. I mean, what the market is doing today? They got smoked yesterday. Today they're, I think today they're down too. The last I saw, I don't really check the markets all that much. Yeah, they're down another, down again today. Look, 10-year Treasury still at 3.5. I still find that crazy. Vanguard foresees the federal funds rate climbing to 4.5 to 4.75, and that will adjust my cash holdings in Right Capital. They expect the Federal Reserve's rate hike cycle will begin to curb in the first quarter of 2023. So here we go. This is what matters most. Our 10-year annualized nominal return projections are shown below. U.S. equities, 4.7 to 6.7, with a median volatility of 17.4. All right, so we're going to use half that. So U.S. equities 5.7 with a volatility of 17.4. So let me show you what that means. 5.7, 17.4. So we take, I don't have my calculator. Financial planner without a calculator is naked. It's like Fauci without his white lab robe to show that he is a real doctor. Everybody, look, he's wearing a white jacket. Fauci. Such a clown. 17.4. Sorry, YouTube. I don't mean to get banned by saying Fauci's a clown. 17.4 times 3, 52.2. All right, so what that means is we take our standard deviation, three standard deviations, which is, Pablo, 99.8% of the time, if memory serves. I'll never forget that. I always forget. But basically, within 99.8% of the time, we will get around this mean, the average, 52% around the average, all right? So in any given year. So 52% minus 5.7, we would have 46.5 on the downside, 52.2 plus 5.7, we'll have 57.9 on the upside. Let me just write that again. Hold on just a second. Hold on, everybody. 57.9. All right, 57.9 or 46.9 is the ranges of our returns with a 99.8% probability. All right, so that's what we'd expect. Now, we've never had a year that we're down 46.9%. And for those of you who want to say 1930, well, look at what inflation was in 1930. So this would be the worst year ever if we ever had that. But I'm going to use it because I think it's that important. Now, they differentiate between growth and value. I don't. That's boring to me. They differentiate between large cap and small cap. I don't. It bores to me. Real estate. Now, they have global equities at 8.4. I'm not using that. I'm using 5.7 across the board, man. That's all there is to it. Global equity is at 8.4, the standard deviation just a little bit above the United States. No, I mean, look, I don't use that because, frankly, you can have global equities, but I'm not going to say we're going to get an 8.4% rate of return in global equities. I like to err on the side of caution in everything I do. Here's where the big difference changes. They got bonds giving about 4.6%. That's significantly higher than what I've been giving, 4.6%. And I'm going to go with it. I'm going to go with the Treasuries, which is, was that 4.2. I'm doing that. Treasuries, 4.2. I think you have to. No, you don't have to, but I'm just saying you have to look at the market as it is. What can you get on your investments today relative to where it was last year, especially when the markets are down? And when the markets are down, it just means there's more potential for return. It just does. Doesn't mean there will be, but I mean, look, the 10-year Treasury is still at 3.5, man. You know what I'm saying? But the shorter term ones, hold on a second. I still can't get over the 10 years at 3.572. The 30 years at 3.577. But the 90 or the 13-week bond is 4.245. So I mean, I think you got. So right here, fixed income, about 4.2%. Seems spot on to me, man. And then they got cash at 3.4. I'm gonna use 2% for cash. That's tough. And they got inflation at 3.5, which we'll use. Anyway, that's good stuff, man. The probabilistic return assumptions depend on market conditions at the time of running the VCM at 100%. Now they got other things in here, and I just frankly don't care that much about. But that's what I'm using, man. I'll put a link in the show notes. I'm going to update the right capital right now, as a matter of fact, to change that for 2023 and forward. And again, every year I change it based on what Vanguard says, because I trust Vanguard implicitly. They've always been on the conservative side. They've never been overly aggressive, and that's big. That's good stuff, man. And I appreciate that. But they're not like Jeremy Grantham at GMO, like, oh my goodness, we're all gonna die tomorrow from climate change, as they're raking in bank, funding ICL, funding all kinds of stuff. That's Imperial College of London, where Neil Ferguson did his scams. The whole thing's crazy. All right, love your thoughts. We'll see you